Hello traders, the title of the video is how to deal with Elliott wave trading surprises without being surprised. Alright, so sometimes it is normal, alright, that an Elliott wave trader is surprised by the price action. All right. Now, those surprises very often will occur when one is becoming a bit, too confident. All right. Anytime you are trading and you are becoming too confident with the Elliott wave, you want to pull back a little bit, all right, and adopt a different approach. All right. Now, because the Elliott wave can be a little bit addictive, can make you drunk, so to speak, and you have this euphoria. Because if you count it correctly, you say, all right, you see the first wave, the second wave, all right, and then you enter nicely at the end of the second wave, and then you see 1, 2, 3, 4, 5, and then you come out at the end of the third wave. You see the feeling, and then the fourth wave, you sell it, pull it back, and then you join again the fifth wave, all right? Now, and then everything is looking so gorgeous, so beautiful, working, and a big smile, all right? And one can get carried away, one can be very, very, becoming too confident, all right? And that's when an Elliott trader can have, can have surprises. Now, the problem is that the surprises, how do we deal with those surprises, all right? Like a smart Elliott trader, and get back in line and take control. That's what you want to do. It's like you are driving, you got distracted, and then the next thing you want to hold the steer with your two hands, the wheel with your two hands, and take control and drive it nicely, remembering that, all right, I'm now on the motorway, all right, a highway, and now I should focus and drive normally. Okay, this is what's going on. So how do you deal with Elliott wave trading surprises without being surprised? So the first thing that you should do, so you can avoid Elliott wave surprises, just know that we are flowing with the price, and the Elliott wave count is one step at a time, and that the price is the king, and he can do anything that he feels like. That's all. So when you see sometimes the price turn around, when you see you call something A, B, C, D, E, and then you buy the price, say, oh no, I'm going to oscillate more, blah, 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 blah. Or you see a clean cut, flat correction, and then the price stick the finger up for you or do something that you were not expecting. You just know that, you just smile, You just smile and take control again. That's it. But what I'm saying to you now, maybe you never experienced, some traders find it very difficult to get back in line because they are fixated, or they have this mindset, or everything was euphoric before, and they were no accepting that the price can do something different. That's where they are surprised. This is one example here. And then together we will look at it. You can see that I show you here, I called this a first wave previously when I was counting wave. By the way, the financial instrument that we are analyzing today is the US dollar, Turkish lira. All right? So USD TRY. All right? Uniform Sierra Delta, / Tango Romeo Yankee. On a monthly chart, all right? As always on the monthly chart. So, you see here, first wave, just feel free to disagree with my wave count. Second wave, and then we say third wave, fourth wave, and fifth wave. And I put the fifth wave there, you see that? See my fifth wave there? All right, it looks like the price went a little bit above it to retest maybe 138.2% Fibonacci extension level of the third wave, blah, blah, blah. And, but then look, it just... Now, one of the factors that usually create big surprises to technical traders is what? The economy news, especially when we are talking about currency pair, a change of policy or implementation of a central bank decision, economy news, or political event, geopolitical event, global macroeconomic news can just, change everything else that we were talking about before as a technical trader or as an area way trader. So those things can change the dynamics. So as a forex trader, in fact, you shouldn't be surprised at all with all the ups and downs that usually happen very fast in the financial market. So one of the factors, remember, economy news if you are trading forex. So the Federal Reserve, United States, so beginning of the year, we were not expecting them to put, well, I mean, the expectation was that they would put our interest, but we didn't think that they would keep doing it as they are doing it now. And you can see that recently, the dollar was strengthening big time against, all right, the Turkish lira. Now, I'm asking a question. Remember this, it's a question. Is the American government also punishing the Turkish government for, okay, trying to stand in front of them? You know, there are some political issues before that story about the pastor that the Turkish people were holding. Now it's the superpower punishing the little power. All right, this is just to to make a bit of political okay point here. All right, so all in all, something has happened. Okay, Federal Reserve is becoming very hawkish, putting up interest rate. The US dollar will appreciate against all major currencies, including the Turkish lira. Now, the other factor that we should understand, all right, from, you can see, from 2009 up to 2016, in fact, all right, all the break, talking about Brazil, all right, South Africa, China, all right, and Russia, that's what they call break. B for Brazil, R for Russia, I for India. What's the next one? Okay. And then we have South Africa, okay. So those countries, during when the Federal Reserve was devaluing, okay, the dollar, those BRIC countries, their currency were going up. Brazilian real was going up, big time Turkish lira was going up against the dollar, all right? So, in fact, so during that time, this currency pair will be going down, which means dollar will be weakening against, you see, it went down a little bit here, but something, okay, by the way. So there is another factor which I'm mentioning now very fast, okay? But how do you deal with the area way surprises? Like here now, so I counted 1, 2, 3, 4, 5 without going too far away from the topic, all right? So I put my 5 there, you remember? The line was there, I was expecting it. Probably that we go see the correction starting somewhere in that zone, all right? So down here it is going up. What you need to do, all right? Whenever, especially when you come to the end of the fifth wave, that when usually sometimes surprises will arise now. So another thing that one can do to avoid surprise is that we know that the first, the third, and the fifth wave can be extended. So it shouldn't be a surprise when the fifth wave is extended. It shouldn't be a surprise when the third or the first wave is extended. And the big surprise usually occurs when the fifth wave is extended. Because all the area wave traders come with 1, 2, 3, 4, 5, and then they say, all right, we're expecting a correction. So everybody is waiting to sell, or yes or no. No one wants to buy. So then we see all kind of price slow down a bit. You see bearish candlestick pattern and so on. But surprise, surprise, the price breaks above it and then run away like it did here. So what you need to do to deal with that is very simple. If you have a fifth wave like this, all right, and you are wondering what is likely to happen, what will be the scenario if the price starts running up, or if, for instance, you were selling during the fifth wave and that's suddenly the price run away from you and you want to get your money back, all right? If the third wave, you see here, you saw divided into 5. 1, 2, 3, 4, 5. This is a good scenario. If the third wave is subdivided into 5, what you need to do is to apply Fibonacci extension to the fifth manual wave of the third wave, you see here, because that's the last, okay, bullish move before the fourth wave. So you will apply the Fibonacci extension to the last straightforward bullish move before the fourth wave. You see here, that's the last one. If the price didn't pull back here, but did go up from here straight to here before the fourth wave, then we will start from here. You can see here it was a pullback before. So the last bullish move that is straight up like this, in the third wave, apply Fibonacci extension to that. All right. That's one way to determine or to avoid surprise. Once you draw that line, okay, highlight the first level that I want you to highlight is 161.8% Fibonacci extension level of that move. As you can see, the price breaks above it. You see here, there were sellers here, but it pulled back to retest it. So that candlestick bar here, you see this one here, it's very bullish. All right, so price open here. All right, it went up all the way there, but now I mean, we may say theoretically speaking it's bearish, but in fact it's bullish because they sold it down. The bullish trader were trying to push it down. They sold this one down. You see all the way here. Look, that was the level they pushed it down, 4542. But as they were pushing this one down, they couldn't bring it to the same level. In fact, the price closed above that level. That's why I'm saying to you that though it looks bearish, you need to be very careful. That candlestick bar was under a serious bearish fire, but it did survive. It's closed bullishly above another bullish candlestick bar. Now the second candlestick bar will tell us what is likely to take place. So there is a high chance that we give, if the price finds support above the closing price of this one, that it will go up. But if you find a resistance below it, we will sell it. That will be, okay, a strategy that one can deploy at that point in time. So once you apply Fibonacci extension to that bullish move, highlight the 161.8% Fibonacci extension level and pay attention to the candlestick pattern here. The reason is, all right, bullish breakout will occur above 161.8% level, 261.8% level, and the 361.8% level. Now, I did talk about this at the Day Pro Traders YouTube channel. You see now? So, highlight that bullish move, apply Fibonacci extension level, highlight 161.8% level. If your forecast fifth wave is below the 161.8% level, all right, I understand that if the price crosses above that 161.8% level, you need to be on your toes. You need to be alert because it can run away. This is what's happening here. This is what happened here. Because the first resistance above that bullish move is the 138.2% level. Now the price breaks above it, so the next resistance is 161.8% level. Now, we know that the 161.8% Fibonacci extension level is a breakout zone like the 261 and the 361. So, as you can see here, if you see a bullish, so suppose you were here, you were selling, all right, you were selling before somewhere, before 161.8, and now suddenly this candlestick back came and take you out. So, oops, you are surprised, yes or no? You are. Maybe you are not. Maybe you know. Okay, maybe you are prepared. Maybe you know that, all right, it's normal. So you want to get your money back, yes or no? That's what we do care about. So the best way to get your money back is above the 161.8% level, if they allow you. So this will be here. A lot of, I can assure you now, like I come away 1, 2, 3, 4, 5 here. A lot of Elliott traders were taken out here as the price was running away. That's why we have this long candlestick bar here. A lot of people were taken out. You see this long candlestick bar? Okay, stop loss being taken out. It run fast. Surprise, surprise. You see. In a downtrend, you do exactly the same thing. You apply the Fibonacci extension to the last section of the bearish move during the third wave. All right. Also, understand that the first, the third, and the fifth wave can be extended. So you want to also draw, apart from everything that I said about Fibonacci extension, 161.8, 261, and 361, draw the key levels. The essential key level. Use price target also, as we discussed before. So if the price breaks above a key level and find support, don't ignore it. So you will draw your trend line, you will draw your channels, all right? Well, like we said before, pay attention to the price action. But in this tutorial, the number one first thing that you want to do, you want to know where is that, okay, 161.8% level, if especially you are calling something a fifth wave. Because it often happens when Elliott wave traders, okay, are surprised that the price is still running away, and they say, "What's going on? What's going on? What's going on, George?" Well, it's a continuation. Price decided to continue to go up. It's becoming bullish. People call it fifth wave. You may have to move the goalpost of your fifth wave, or maybe it's just maybe what we are calling everything else so far. Maybe it's just because sometimes, you know what's happened? This is a very important point. Maybe this move, that we are calling 1, 2, 3, 4, 5 up to this point, is just a third wave. Right? Maybe it's just the third wave. Usually, if you are calling something fifth wave on one particular time frame, and you see that the price continues to go up more during the third wave, during the fifth wave, probably maybe you are on a third wave of a higher degree and you didn't know. So you are thinking that the multi-wave is ending, when in fact you are in a third wave, you are in the middle of a third wave of a higher degree. That can also create some surprises. So another thing that you can do is to quickly go to the higher time frame to see the bigger picture. All right. So this 1, 2, 3, 4, 5 is still in the third wave. Oof, I might as well continue to buy then. All right? Because psychologically speaking, I mean, Elliott wave trader, as soon as they see fire, we are thinking, okay, it's time for it to see a kind of correction. Maybe the correction is not going to happen yet. Maybe the correction will be shallow. Maybe there will be an extension. So those are the things we want to take into consideration. By talking about practical Elliott wave trading, to avoid one way, so one example. So we're talking about different way, but one example to have one way to deal with Elliott wave surprise. Like I show you, apply Fibonacci extension and highlighted 161.8% level. That's the first level that you are watching. As you can see, the price acknowledges that level. It didn't acknowledge, it went through it fast. You see, this is resistance. It went through the 261% level, but it did acknowledge the 261% level. That's where it's coming down from. So, if a reversal does not occur at 161.8 or 261.8 or 361.8% level, we are likely to have a reversal. Normally, when we are talking about reversal Fibonacci key level, we are talking about 138.2% level, 238.2% level, or 338.2% level. Yes or no? Those are reversal Fibonacci extension level. The breakouts level are 161.8, 261.8, and the 361.8. But anytime the price reaches the 361.8 or 261.8 or 161.8% level, and it just fell big time to find a support above it, well, it's time to sell. This is what's going on right here now. This is not a surprise at all for somebody who understands the breakout point. This is not a surprise at all. 1 month, he couldn't break above it. He found a resistance. Well, something's going on here. You want to give priority to bear signal below that 361.8% level because the price coming is not finding it. So it's going down now. For those who are day trading, is to look for an opportunity to push it down to 55040. The financial instrument that we are analyzing is US dollar, Turkish lira. So it's coming near the 261.8% Fibonacci extension level. I don't want the video to be too long, so it's just one example, okay, how to deal with Elliott wave trading surprises without being surprised. Even if they push the price very fast, as it happened here, you see now. All right. You can still get your money back by highlighting the 261.8. Sometimes if you run through the 161.8% level, sometimes you may have a chance to enter 261.8, provided that there's no reversal there. You press the ball and find support. Or you'll catch up and get some money back somewhere along the line by doing exactly what I'm showing you now. Or if they take you out, you couldn't get your money back. If the reverse is occurring like it did here, those people that they took out here, now they have to be sellers, selling to get their money back as the price coming down. So they were buying before or whatever they were doing before. They were attempting to sell, but they are taking out. Now, a better selling signal is appearing at the best place. Well, why not sell it again? This time, when it's time to sell, it ran away before. Now it has stopped at the station. People are selling. Well, you can sell again, yes or no, using a different time frame trading method. Like I said also, one of the reasons why we have surprises sometimes is because you see 1, 2, 3, 4, 5, but that 1, 2, 3, 4, 5 is a portion of a higher degree third wave, and the third wave is extended. But because you're on one particular time frame, like now, this is something important. If, for instance, I'm missing some data here, suppose there was some price action here, and other traders have it on their chart, they are calling this first wave, and they are calling this move here. And they are calling this move down here second wave. And now all the things that I've been calling 1, 2, 3, 4, 5 is just a section of the real third wave of a higher degree. So those traders that count their way like this won't be surprised to see the price continue to go up more, because they know that they are in a third wave, so the price can be extended. But because my wave count, okay, I put it like this and like this, all right, and I'm thinking that, okay, the correction is due here. Yeah, they push it up. I say, all right, probably it's a distortion. They're going to break it down more, okay, and now it continues to go up, creating a surprises. How do you deal with that? This is what you need to do exactly using Fibonacci extension. Look at, they are bringing it down to this is a nice, okay, trading opportunity. You see, on the hourly time frame. So sometimes you'll be wondering, why is it going down? It's just going down. People will try to buy it, keep going down. There's a key level the price heading to. All right, they are catching what they call a falling knife. It's going down. Oh, $1. Okay, Turkish lira is just going down. The dollar is just falling against. You see, just going. People say, why is it going? Just going down. All right. So like now. Now, the reason why I'm laughing is because I've done those things before myself, and I lost so much money. That's why I'm laughing, all right? Sleepless night, losing money, all right? So, like this now, how do we trade this, okay? So, you see that long candlestick bar, we teach traders how to trade long candlestick bar. So, you have the closing price, the body of that long candlestick bar, the closing price, you put it there, also at the low, and you draw the median line of that long candlestick bar. Okay, so those are the places where you want to trade this. So as it's coming down, now, where are we? Where's my media line? Media line is this one here. Okay. Right. As it's coming down like this, fast, all right. For those who did not, all right, sell it at the top, 361.8, as I showed you before. You see how that session, remember the last portion of the third wave that is bullish or bearish in a downtrend. That's the one you want to apply the Fibonacci extension to, all right? And now, don't get confused with what we do before. We apply sometime the Fibonacci extension to the whole third wave to determine the 138.2% level. That's a different thing. What we are discussing today is how to avoid surprises, all right? Because you understand that, very important. All right, now, we don't want the video to be too long. So for those of you who are trading this now, the price has a high chance to because a long candlestick bar, I want to dwell on this a little bit, all right? So if you are interested, you can continue to watch it. Otherwise, I finish my topic in fact. Here it is. When we have a long candlestick bar, draw one line at the closing price, one line at the low, all right, which means opening price, all right, and you draw another line at the median line, all right. So the tall candlestick bar is a distortion to a certain degree. The market will try to rectify that by canceling it. So this thing going down now can come all the way here. Now, what you will see very often, because for more advanced traders, sometimes the price will, if it kind of to this level, all right, 49294. Sometimes it may not find a support there, so it will start going like this, almost diagonal. Are you with me? So it come down, like this, touch that pink line, and then it will again go down like this. All right, all right. Are you with me? All right. Now, before it will find a support and go up. But if you are already selling it, all right, it's going down. Some traders should be prepared to take profit here. If they are not taking some profit here, it's up to them. How they control their risk? It's up to them. If you did not sell it here, this will be a place to watch. Break below, retest. All right, but don't forget the 261 because here 261.8. Talking about this move here, just a little bit there. That's why they are bringing it. All right. So those are the key level. For those who want to day trade and play this one down, those are the key level you want to watch. But don't forget the 261.8, all right, and other key level. So sometimes it may count down completely cancel. Another scenario is that the price will count down to the media line, which is the pink one here, like here, and then you go up like this. You come down all the way here. You go up again one more time, and then you go a little bit like this. All right, before you count down again. So remember, you can count down, cancel it straight away, and then the dash will be settled. You go a little bit like this before you go up. Or you may count down like this, return the media line, and then go up. All right, and then count down like this. So this will conclude our discussion today about all right, how to deal with Elliott wave trading surprises without being surprised. So to summarize this video, to avoid Elliott wave trading surprises without being surprised, one should apply Fibonacci extension to the last leg, so to speak, either bullish leg in an uptrend or bearish leg in a downtrend of the third wave. Apply Fibonacci extension to that price action and highlight the 161.8, the 261.8, and the 361.8% level. One should always understand that one of the reasons why there are surprises sometimes when one has counted 5 waves is because sometimes that 1, 2, 3, 4, 5 is a portion of a higher degree, a third Elliott wave. Another reason is just can be the extension of the third wave or extension of the fifth wave itself, the Elliott wave extensions. So at the end of the day, a simple way to avoid surprise is just to draw the trend line, the channel, the key levels. So when the price breaks above a key level, they find a support. If they have already taken you out of the trade, if you find a support, well, don't fight it. Now become a bullish trader, okay, when you after they have taken you out of a bearish trade, if the price finds support above the key level, use a different time frame trading method. One thing that will generally help Elliott wave traders is to understand that the price is the king and the price can do whatever the price thinks is right for itself. So normally we shouldn't be too surprised when those kind of things happen. We can just smile, shake ourselves out, and take control again of our trading without any emotion. All right, so this will conclude our discussion today about how to deal with Elliott wave trading surprises without being surprised. All right. If this video has been truly useful to you, please let us know by giving us the thumbs up. If you dislike it, please mark it down. If you think it's an essential tutorial that can help other Elliott wave traders, okay, please feel free to share it on Google+, on Twitter, and also on Facebook. If you have not yet subscribed to our channel, please subscribe to our channel today. It's free. And be sure to click on the notification bell. Check our Facebook page, Stochastic-MACD, all right? And also, like our Facebook page. If you're on Facebook, subscribe to our YouTube channel, all right? So you can follow us either on Facebook or on YouTube. Happy trading to you all, and I will speak to you soon. Thank you for watching.